Good afternoon, everyone. Welcome to this TradeStation webinar. I see some familiar names. Thank you for joining us today. As you can see, I'm joined by my colleague, Brandon Wendell. We'll get to him in just a moment. I just have to go through some of the disclosures and introductions of the class. Today, it is Futures Options Replay. So we're going to take a look at Futures Plus and some of the options, single options, option spreads that Brandon has been thinking about in this past week, what worked, what didn't work. But the important thing is that we're going to take a look at key insights and strategies that Brandon has been thinking about. Brandon is a trader and mentor. He's not affiliated with TradeStation, but it's always a pleasure to have him. My name is Jesus Nava. If it's the first time that you're joining us, I head up the education team right here at TradeStation Securities. For both of us, it's always a pleasure to be here. Keep in mind that every symbol and idea that we talk about is for educational purposes only. TradeStation doesn't make any sort of recommendation. And if anybody needs additional information on the risks associated with online trading, go to tradestation.com/disclosure. Not that one. Tradestation.com/important dash information. That's the link that will have all the information associated with our disclosures. Again, it's a pleasure to have Brandon with us. I'm going to just let him do his own introduction, but Brandon, the microphone and the floor is all yours. Great having you.
Excellent. Thank you. Great to be here, of course. And I'll go ahead and kick this off with sharing my screen. And there we go. You should be able to see it. Awesome. So yeah, welcome everyone to, actually might as well put it back here, Futures Options Replay, Key Insights and Strategies. Obviously, we do focus on the futures markets and the options on the futures markets, talking about leverage on leverage. I'm not going to spend too much time on me because it's not about me, it's about you. But I am a chart market technician, been active in the markets. Actually, it's 96, 97. I've worked for hedge funds. I've worked for private hedge funds, brokerages, and I've been in the education realm since 1999 when it comes to the financial education, that is. I've been an expert on CNBC, Bloomberg, Fox Business, all that good stuff, and been trading ever since I got into the business. Basically, I started off as a retail broker and hated it as a salesperson. Ended up moving into back office operations, love trading, love figuring out what makes the markets work. And I've been able to parlay that into my career for the past almost 30 years now. So it's crazy. I can't believe it's been that long. And anyway, we're going to talk about options on futures and some of the opportunities that I've identified over the past couple of weeks and actually still looking at today, as a matter of fact. And of course, if you have any questions on anything we've already gone over in the previous sessions, or would like to look at as well, let me know. And I do have the Q&A, or sorry, the chat open to be able to monitor some of that stuff and see what's going on there. As a matter of fact, I wanted to take a look back at, I don't recall the last time we were together, but I do know it is available on TradeStation.com. They have the recordings of all these events that we do. And yeah, you can go back in history. And of course, there's information on options and information on futures in TradeStation's website. That being said, I am not a TradeStation employee. I am just invited here to speak to you guys. And one of the things I noticed recently about, it's not really just recently, it's been like this for quite a while, but the Russell 2000, obviously with government shutdown, we are not getting a lot of news about the economy because the reports on all these are pretty much done, but we're not getting any reports until the government reopens. Let's see, I've ever done 0 DTE on ES and RTY. I usually do 0 DTE every day on the SPX. I have tried it on the ES and Russell, and I prefer the indexes over the futures in that particular case because of the European style. No, I don't have to worry about the assignment on the short side there. So depending on what strategy I'm trying to employ, the pricing is going to be different whether you have European or American style options anyway. And basically, what I was saying about the Russell is that it's going a bit sideways. You go for channels for a period of time and then break out into a new channel. And you can see that's been happening over and over and over again. Even the move to the upside, you can almost draw a channel across that as well. And by the way, if you're not sure whether an option is American style or European style, there's this really cool tool in CME Group you can go to. You just do a search. If you don't bookmark it, do a search on the homepage of the CME. You'll see the magnifying glass and type in contract directory. And that'll take you to this page, contract directory and calendar tool. For instance, if I go to the equity markets and I want to look at that and how the options work, right here is the calendar that shows all the options available. So let's see, we can go to the monthly, which should be, is it EW? That's the second week, third week. I think it's EWX5. It's that one right there. And you can see actually this one is a European style. So you can still sell those. However, when you go to some of the dailies, I'm not sure if those are European or not. Yep, that one is too. So that also is European and actually has the same advantages when it comes to the zero DTE. So I've just stuck with the index, but yes, it is possible to do the zero DTE on these options on futures rather than on the index itself. And obviously, they're going to trade according to the underlying future, and you can even see the underlying futures right there as well. And it shows you that the ES financially settled. On the option, though, this is today's option that just expired. And let me zoom in a little bit here so you can see that. The symbol is E4AV5. And then you'll say E4BV5, E5C. The numbers, again, they all mean something. A, what it looks like is Monday's expiration. B, Tuesday. C, Wednesday. And then you have D, and of course, E. Actually, there is no E. It's just the weekly. And the week also corresponds to the week of the month. So 1 is the first week, 2 is the second week, 3 is the third week. Anyway, you can learn more about the symbols in the masterclass that we did on options on futures. So I was asked to do a workshop with you guys before on that. And if you go to the Futures Education Center, there's a masterclass. And actually, Zeus put in the link for you there as well for the options replay. But also in that education center, you'll see the masterclass actually. If you go there, if I can find it here, hold on a sec. Yeah, I'll go to masterclass. Hang on a sec. And if you scroll down a little bit, you'll see, there we go, future spreads and options. And it might be under the guest. I know there was a masterclass session that I did in here. I'm just trying to see exactly where it is. But anyway, you can look up in there. I'm not going to spend too much time on that this moment. But anyway, looking at the calendar directory, same thing with the Russell. If I go to choose a different product, I can go to the Russell. And you got to pay attention to the symbols because they are going to be different. Again, when I go to the main page here, and I'll zoom in there so you can see it better, you notice on the ES, the symbol is still ES. The Russell, however, the future symbol is still RTY. However, RTO is the option symbol. So when I go into that one, first of all, you'll see it's not always RTO because, again, you've got those weeklies that are being traded. And yes, you could do zero DTE on those. There is today's that expired. It shows you first available date. They are European style. And again, keep going through these, and you can also see which future they're based on. And it says financially settled. However, the options are deliverable, but you can't take delivery on, you can get a delivery, excuse me. Where is it here? There we go. As I zoom in. This may be part of the issue they have to deal with is delivery of the underlying contract. So if you are in the money or out of the money, you may end up having to worry about delivery of a particular underlying futures contract, and therefore your margins are going to change because you might actually get into a position with the option margin. However, once that option becomes assigned, now you have an underlying position, either long or short, in the futures contract because these are deliverable. Meanwhile, when you have the options on the indexes, those are cash settled at the end of the day, so you don't have to worry about any kind of position. And that's another thing, another reason I couldn't remember why, but that was another reason why I trade the index for that particular situation. But could you do it? Yeah, absolutely you could. Pricing is just going to be different. You just got to be mindful of it. Speaking of the Russell, as I mentioned, I was looking at this and the Russell, again, looked like it was going to be a bit sideways because with the government shutdown, we're not getting a lot of financial data out there, and I don't see a whole lot of price movement in that particular index. Obviously, every index is a little different. We had a very bullish day in the NASDAQ. Hopefully, you were able to take advantage of that. I know I did. Let's see, where is it here? There's my desktop. Let me minimize or push this out of the way. And key 25. There we go. We had the nice run to the upside, but actually, before we ran to the upside, and let me actually I'm gonna get rid of this guy for now. Disable. There we go. I don't like too many things on my chart. But before it ran to the upside, believe it or not, it actually bounced off of an area I was watching. I believe it was a 15-minute pre-market demand zone that I ended up buying at and took off from there at 9:30, which is really nice. So hopefully you were able to take advantage of that. Yeah, there it was right here, first thing in the morning. Let me disable the bands. I'll actually get to the options here as well. But you can see, first of all, this is how I trade. And honestly, when it comes to options trading, I do the same thing as what I do with my individual futures trading or stock trading, whatever it may be. I basically take 3 steps for options trading. Now, there's a lot of little pieces in there, a lot of nuances, but the main thing is number one, am I bullish, bearish, or neutral on the underlying security? For me, on the NASDAQ, I was bullish this morning. And you can see right here at the open, I think this was 9:30 candle, if I'm not mistaken. It's 9:45. So it was after the first 15 minutes we came in, slammed into origin of demand, and we never looked back. So it was a really nice day for trading on that if you caught that. It was weird because this was buying pressure from 5:45 in the morning, wasn't even news driven, which is even better. But anyway, my second step is, are options cheap or expensive? So again, the first thing, let's see here, take that off, go to text. Step one, are you bullish, bearish, or neutral on the underlying? And then number two, are options cheap or expensive? And number three, choose the right strategy and obviously employ it and manage it properly. And I'm oversimplifying things a little bit, but that's honestly what it comes down to. So, for instance, with the Russell, I was neutral on the underlying security. So, again, I go back to my slides here just to show you what I was looking at, and I was neutral, expecting us pretty much to bounce off these highs and stay back and forth between this 2550 and 2450 range for the foreseeable future. I don't use a whole lot of indicators. And you can see I've got 2 moving averages on my chart, which is part of a strategy I created about 15 years ago. I also use the RSI on the bottom, and there's YouTube videos I put out there. You can see some more info on that. But I use that as a momentum indicator, and we have not been overbought or oversold since late September. We had a small overbought situation there. And you'll notice that actually that's set at 70-30, which is incorrect. I usually use 60-40 because I'm looking for not overbought, oversold to go in the opposite direction, because that's not usually what happens. When you become overbought, you can become more overbought. That's a bullish trend. If you're oversold, you can become more oversold because you're in a bearish trend. So if I look at the actual Russell right now, and this is the NASDAQ, I know I'm going to switch it, and we need the daily chart. There, that's set on 60-40 right now. That's what I usually look at. Overall, we are bullish, but again, we have lost momentum. Notice how we're not getting into that bullish area. All the peaks in price back here, where we're making highs, 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 we are becoming overbought. So they're showing lots of bullish momentum. We're not going to become oversold in a bullish trend. It just will not happen because it shouldn't. If you're in a bullish trend, you shouldn't be oversold. So I'm just looking at this to see when the momentum is dying, and it has died on the last 2 peaks. We have failed to close above 60 on the RSI, which is telling me we're likely to just go a bit sideways and drift. If you go back in time, or even better yet, I'll use a continuous RTY and go back. You can see we have been bullish for quite some time. And notice here, where we're going below 40 and not above 60, we're in a bearish trend. When you're in a bullish trend, you don't become oversold. When you're in a bearish trend, you don't become overbought. And in sideways trends like this, you stay in between those lines. That's where we are pretty much for the current picture, in between those lines. So we have lost momentum. The other thing I wanted to look at, number one, I figured out, okay, I'm neutral on the markets. And we have a lot of strategies we can employ when we're neutral. And as a matter of fact, if I go out to OptionStation Pro, and I'm on the wrong symbol here, so let's do RTY Z25. Now, I can't trade on OptionStation Pro, but I can do a lot of analysis on it, which is very useful, obviously. So it's entirely up to you which one you want to trade on. If you want to trade, if you want to trade, and you'll see if I go into this and try to put in a position on whatever option, it'll say, listen, you can't actually trade this unless you go to FuturesPlus. So you got to make sure you have a FuturesPlus account to trade options on TradeStation. So I can do all my analysis here, which is fine. But ultimately, where is it? Up there it is. Got too many things open. Sorry. Here's my TradeStation FuturesPlus platform. And that's what I'm going to be using to actually affect my positions. Once I get my data loaded, that's weird. Okay, there it goes. Just takes a moment sometimes. Anyway, getting back to this, step one was, am I bullish, bearish, or neutral? Step two, are options cheap or expensive? There's a couple ways of figuring this out. One way is looking at volatility. Implied volatility has a big impact on option pricing. And you also have to realize that with the options, the further out in time you go, the higher the volatility has an impact on your pricing. So zero DTE options, that has the biggest influence by price. So we're looking mostly at gamma and delta there. When it comes to longer term options, that's when we need to be focusing more on the volatility. So for instance, here you can see we've got days until expiration on these options on the Russell. If I were to look at zero DTE today's, obviously it's already expired, but you can see Vega 0.09 at the 2530, and over here was at 0.06. It's almost nothing. And of course, we got some time decay as well. But really, I'm focusing on that theoretical, or sorry, the Vega, the volatility. And when you go further out in time, I'll just go out to 30 days here. And we were at 2530s at 0.09. So 2530, not available. So 2525s. And look at the Vega, it's up to 297 from almost nothing to $3. So there's a big difference, and that's just 30 days. If you start going out further and further to try to reduce some of the time decay, you're going to experience a lot more Vega, a lot more volatility exposure. So I need to know, because first of all, volatility can be the biggest impact on option pricing, unless, of course, again, you're doing very short term, zero DTE, or even in the next week or so. Then you're not really worried about volatility as much. So the way I look at this, if I'm looking for an options trade on the, let's see, which one did I choose? I forget. Oh, I did November 3rd. I did very short-term options because again, I was looking for a short-term move sideways in the markets. So I wanted to know if options were cheap or expensive. And if I go to those November 3rds, there they are. I can see, first of all, I am getting some volatility exposure on the at the money options. And I'm not necessarily going to pick the at the money, but I'm judging it from that point. I can look at theoretical value as well. And based on the theoretical value versus my bid ask spread, I can see, are we trading more expensive or less expensive than the theoretical value? So that's one way of looking at it. I can see, okay, right now, but the problem is that, especially after hours, the numbers are skewed. It's not quite accurate as it should be. So right now, for instance, we're seeing that this 2525 option on November 3rd is theoretical value, the call for 30.50. I could buy it though for $3 less than theoretical value. That would lean more towards wanting to buy options because I can buy them cheap. On the put side, right here, the same put's valued at same strike, 22.55, but we're trading at 26. That's overvalued, isn't it? So we're paying a premium for that, and therefore we may want to sell the option. Like I said, it's tough when the regular equity markets are closed. You don't get as quick of a display of this as you normally would. I think there should be a way of looking. Yes, there is. Theoretical value. There it is. Call theoretical value on TradeStation FuturesPlus and put theoretical value. So if I go into, let's see, I don't have one open. Shame on me. I'll go to CME. RTY and then the RTO, although actually I'm doing a weekly, so I should probably choose that weekly. Oh, I gotta scroll a bit here. Went too far. There we go. RTY, there it is. And again, I could pick the specific option that I'm looking at. And if I don't know the symbol, contract directory calendar tool. It was November 3rd, so it's R1AX5 is the one I'm looking for. And we'll have to see if it's the same symbol in TradeStation. Looking at the FuturesPlus, R1AX25, it is. So R1A, there it is. Monday weekly options on the Russell 2000. And this is for next Monday, November, let's see, 7 days, November 3rd. Yep, that's it. And hopefully this will populate. It should. And since it's not loaded up yet, if I go over here to my crude oil, which I had, still loading that one too. It does take some time because there's a lot of data being downloaded from time to time. Let me see. I have one of them open, or at least I thought. Come on. Yeah, there's December for NASDAQ, for instance. Just as an example, you can see on the columns that I have, and you can customize the columns. You just right click on the columns. Actually, let me do that real quick. Zoom back out, edit columns, and you can put in different columns. The one column that I have that is important to me for this is right here, CTV, PTV. Okay, that's not a television channel. CTV is call theoretical value, put theoretical value. and I can see where are we currently trading compared to the theoretical value. This call is trading above theoretical value, isn't it? Because we're looking at 1975 by 23. Again, the prices are a little off because we're in the off-peak hours for trading. We're getting ready to be in the shutdown period for the futures for the equities. But this is overvalued. So I'd be leaning more towards selling versus buying. There is another way of doing this as well. It is looking at the implied volatility of the underlying future. Unfortunately, you don't have that ability in TradeStation, and I don't think, let me see, if I go to gold here, I don't think there's an indicator for it as well on this platform. Let me check before I say that definitively. We have historical volatility, but yes, no implied volatility there. Fortunately, however, going back to the CME, they have created a tool recently called the CVol index. And there's another way of doing this as well, but the one that I kind of like as well is the CVol index. If I go to the main page for CVol index, and of course you can save it. Oh, actually, I am on the main page here. I went to energy tab, and you could see, if I zoom in again, for instance, nat gas. Okay. The volatility for nat gas right now is showing 69.25. Okay, that doesn't mean anything to me. Okay, is that high or is that low? I can look back at the range for 1 year. That's what I have it set on currently. And I can see that this is relatively low on the range. What does that mean? If volatility is relatively low, then the options should be relatively inexpensive. Okay. And again, I can look at, well, for nat gas, the alternative, and I was doing this with the Russell too. So let me go back. We start off with the Russell, and I'll finish that before I go to nat gas. Unfortunately, here you do not see equity indexes. Okay, we do have yields. Actually, go to the dashboard, you see all of them. So we got the treasuries, metals, energies, price for the treasuries, stirs, those are some short-term, forex and ags, but we don't have the indexes. So what are we supposed to do if we don't have the indexes? That's the alternative that I can use. Instead of using the Russell 2000, I can actually look at implied volatility data on the ETF or the index that actually tracks that, or that future tracks. So in this case, I chose IWM, the Russell 2000 ETF. And what I saw when I was looking at implied volatility is that implied volatility is falling. It was actually, by the time I entered into this position a couple days back, it was relatively high, expecting to go down. If I'm relatively high, expecting the implied volatility to go down, I would expect options to become cheaper. And therefore, I'm going to want to sell options. And what I chose is two different options. One was the iron condor. And if you're not familiar, an iron condor is just two vertical spreads. I simply sold calls above where I believe the Russell would get to before the expiration, basically above that sideways range. And then I sold puts below the range. And I am playing for time to pass, for prices to stay within that range, and basically these options to expire worthless, so I get to keep 100% of the credit that I received, which is $12.80. So if I go out to my Option Station Pro, which I just passed, there we are. And I have the Russell right there. If I go to my analysis, I already set up those positions. I did an iron condor, again, bull put spread and a bear call spread. You'll notice I also did the butterfly as well, just to show the comparison between the two. So again, I sold the 2550, 2575 call and the 2425, 2400 put. That was my bull put spread. And you can see various times, this is 6 days left till expiration. That's the green line for my chart. Shows me my break-even points, which are a little bit shifted downwards. I probably have a little bit better, kind of a bearish bias. Again, when I put in this position, prices were a bit lower. We had moved up since then. And going back to the Russell, there we go. We were still inside the range. And since then, we've gone up to the top of the range, but have not violated. Again, seeing weakness in price and expecting this to come right back down in the middle of the range. And I can see how prices will be affected by things such as volatility. Again, for instance, if I go back to my TradeStation, unfortunately on this page, there we go. Here, showing crude right now, but again, I'll put in RTY Z25. Those indicators aren't going to work for me down there. IV range percent implied volatility, it just doesn't work. But if I use IWM as a surrogate, Now I get an idea of, again, where volatility is in comparison to the historic volatility range. This is an indicator. And this implied volatility in general, I can see when I was putting in this position, I was somewhat high and above the average, possibly coming down. And that's exactly what prices did, or excuse me, volatility has done. It went from 24 down to 23. Actually, it was 25. So about 25 down to 23, lost 2% in volatility. If we return, the average is about where it is now. We may not move much more, but if we were to return to that lower volatility area, you can see what that might do to my charts or my profit. If I do 1% volatility adjustment, now that's at expiration. Obviously, I'm going to collect everything, but looking at it from, let's say, Monday, or no, sorry, that is Thursday, the 31st. With no change to volatility, if we stay where we are now, I have a $247 potential profit at that point from where I got in. But if we got dropped by 1% in volatility, 262, again, from 247. So my profit went up when volatility dropped. The lower we go, the more profit I take. Why? Simply, I've got a negative vega. So I want volatility to drop. If volatility rises, I'm going to lose profits. If I take it the other way and go up, we went from 240 down to 232. So you got to be aware of what's going to be affecting you when it comes to your charts, and I'm sorry, your pricing and your option strategies. What's affecting this position based on what I have with delta, I have a neutral delta. Anything between -10 and +10 is pretty much neutral. You're not playing the directional move whatsoever. And that's what an iron condor is. I'm a neutral position expecting prices to stay within a range. Theta, time decay, is what I'm definitely playing. I want time to go by so this expires. And you can see day by day how that goes closer and closer to that yellow chart for expiration. And volatility, I want volatility to drop because if volatility rises, I'm in a negative vega, that's going to hurt me. And you can see, again, by changing the numbers here on OptionStation Pro. So if you weren't sure what position you might want to take, I'm not sure if it works for futures, but I can go to, search. And let's see, does it work here? It might. You can actually search if I expect, again, a neutral, quiet market, and I would like some limited risk. Notice it shows butterflies. Let's see, was it showing sell strangles, straddles? That's unlimited risk, though. It's interesting. It's not showing me unlimited risk, iron condor. It's just showing the butterflies, but showing call or put butterflies, which are, again, the other strategy I selected. If I'm expecting prices to move in a certain direction, I can put that in. Again, I'm neutral, so I'm not expecting it to go anywhere, but I am expecting volatility to drop by maybe 2%. And I can run a search to see which strategies might work out better for me. And I can sort these by different things: probability of profit, projected profit, max loss, max profit, all sorts of things. I'm not going to get too much into that, though. So again, I chose the iron condor, and I like the iron condor because even though I don't make as much profit, my max profit is $640. And that's the 1280 premium I collected times the point value, $50 a point. Versus, actually, before I go, let me adjust this to my break-even spot, roughly. Oops, that was the last. Move this one. That's close enough to zero. There's my break-evens. Nice and wide, so I have a lot of room for prices to be able to move by next week. However, when I switched to the other strategy I selected, I actually did a broken wing iron butterfly. Now, what makes it a broken wing is the fact that these two legs are not equal. You notice that this one is longer, there is more risk because the strikes are further apart. I basically did a 25-point strike on one side and a 50-point on the other, I believe. Let's see, call, 2550, 2575. No, it should have been the same. I'm not sure why it's showing a broken wing like that, because they are 25 points apart, aren't they? 2550 and 2575, yes. 24 and 2425. Anyway, so you can see that now what's happening with my break evens, these were the original break evens on the iron condor here and here. The break evens on the iron butterfly are completely different. I have to go much further in for that break even here. Usually they're more narrow, but the profit will be higher. Instead of the $680, now it's $2,475. So I'm accepting more reward if I get the full reward. Now, that max profit only happens if we expire with the underlying futures right at that strike that I sold. The odds of that happening are very low. And by the way, looking at the other side, again, you can see I've got a little bit of a bearish bias, although I didn't have as much when I got into the position. It's just because of what's happened with price. It moved up quite a bit. There's the break even on the downside, but it's shrunk on the upside. It came in, so I have more risk to get more reward. And you can even see that with my max loss, $1,275, max profit, $2,475. There we can compare the two, 640, 610. And let's see, where's my spreadsheet? There it is. My comparison I put together for these two. There's the Iron Condor, Iron Butterfly. Again, you can see the profit and the amount of risk on the two. Rate of return is actually much higher on the Iron Butterfly. My rate of return is 194%. Again, the likelihood of that, though, is lower because that's only if we get our max profit. And basically what I was looking at, I had set some targets for where I expected prices to move to because I was slightly bearish. And if we move to the first target, my return on risk or rate of return on that was 103% because I was still going to be getting the full maximum profit on the Iron Condor. The Butterfly wasn't going to earn as much, though. It was only going to get 160% rate of return because we're not expecting it to be right at the strike where it expires or when it expires. And I can see my break evens to the downside. Notice the break even to the downside is higher. This is when I entered the position. Obviously, things changes the volatility, changes in price, they adjust, and you have to adjust your stops as well. And the break even to the upside, notice how much tighter this is. Okay, instead of having 24.12, I am 12 points higher in my break even and lower on the upside for the break even. And initially, I was a bearish bias, as I showed you on the Iron Butterfly. It's gotten even greater as prices have moved. Time decay did decay faster, but as far as volatility, I had the same exposure. So it's a personal preference, which one I wanted. If I was willing to take on the additional risk, then I was better off taking the Iron Butterfly for a little bit more safety, even though I don't make as much, then I take the Iron Condor. Again, personal preference, which one works best for you. As of right now, they're both in a winning position. I don't have them in this platform. I have them on my other computer that I can't log into right now for the open position. But if we were to go back and recreate the same position, which again, let me move this out of the way, you'll see what the current values are and how much profit there is. So this is the November 3rd. Again, the Iron Condor, start with that one first, 24, 25, and 50. So selling, buying, and then 50 and 75, 25, 50, 75. And if we use the natural price, I did the wrong one there. What am I doing here, Brandon? Come on. Yeah, do the calls. There we go. 50, 75. Come on, there it goes. And now you can see that the current credit is 1140. My initial credit was 1280 that I took in. So if I wanted to close this out right now, I could obviously close for what, $1.40 credit, because I would buy it back for $11.40, which I sold at $12.80. So I have $140 profit already. Not all that impressive, but again, still waiting for this to go. The Iron Butterfly, however, that I entered for $49.50, and that is $24.25, $24.75. Obviously selling the same. So I'm going to close that. Come on, $24.75 and $25.50. Oh no, it was broken wing. That's right, because you can see why it's broken wing here. Look at the space between the two strikes on the calls versus the space on the strikes on the puts. I was thinking it's $25.75, but yeah, that's the difference right there. That's why it's broken wing. I only have 3 strikes here. Here I have 4 strikes between the two. So that's why it's broken wing. Either way, it's now at 53.10. So if I buy it back, 53.10, 49.50 is what I originally took. That's $360 profit. So it's double pretty much what I would be getting for the Iron Condor. Again, I had greater risk, so I should be getting greater reward, obviously, for the position. Oh, actually, I didn't do the natural price, did I? I did the mid price. So actually, it's about the same in that case, because I got in, right now it's 50.80, but I got in at 49.50, so $1.30. So they're roughly the same amount of profit right now. And what is it that I'm getting right now? Really nothing but time decay. That's all I've really profited in this whole position because, again, looking at these analysis here, too much open. There we go. With the iron butterfly, price isn't really helping me out much because of where we are. We've gone way up above where we should, but the time decay and more also, not in addition to time decay, the volatility has dropped by 2%, and therefore my Vega has helped me out as well. So we'll see how this continues on, but that was one of the reasons why I chose that particular strategy in that particular position. So we had the iron condor, and I mentioned the iron butterfly, broken wing in this case, because again, I had a bigger space between the two on this side than I did over here. I only had, 25 points, and this one was 24.75 to 25.50. That is 75 points. So it was 25 points bigger on one leg. Any questions on that decision-making process and what's going on with that trade right now? Basically holding it until the 3rd, and we'll follow up hopefully on our next session together. I think it's next month, and we'll see how this one turned out. Another one that I actually have going on right now is the Australian dollar put spreads, and that is actually losing, but not losing all that much, fortunately, because the prices are above where I got in. I think I forgot to monitor this one, but it's 2 different put spreads. I have 65 put, and then I sold a 64 and sold a 63.50 against that long 65 put. Let's see, page, there we are. And the Australian dollar is ADZ 25. Keeps popping up saying that we don't have that indicator available here. That's fine. Actually, I should go to the other page so it doesn't keep popping up. I can use that chart instead. My keyboard acted up there. There we go, AD is 65. And you can see we're above 65 right now, which is why it's in a losing position. As a matter of fact, looks like gapped up quite a bit there above 65. So I'm in a losing position, but it's still benefiting from a change in volatility right now. And again, I don't have the volatility available for me, but I could use that tool, CVol from the CME, and we can go to Forex and Australian dollar right there. You can see that we're currently right around 9. I'll zoom in so we can see it. We're currently right around 9, and that means we're at the bottom of the range and actually moving down right now. So just because we're at the bottom of the range doesn't mean we can't go lower. We obviously could and have been going down recently. You can see the trend is going down, 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 down in volatility recently. I had one day up and the rest of them all down the last 5. So it's definitely a bit bearish right now. I'm sorry, volatility is bearish, not necessarily the Aussie. Okay, the Aussie was actually slightly bullish, but volatility is dying off. That means if I'm looking to get into a new position now, I may want to benefit from a rise in volatility, which would happen by having a positive vega. That would require me to buy options. You just simply look at the option chain, ADZ25, and depending on which options I wish to choose, typically when I'm going long on options, I'm worried a bit about time decay. So I'm going to go further out in time. And the nice thing about this, if I do go that further out in time, 30 days available further out, or again, I can choose different ones. I want to look for some liquidity as well. I want to make sure I'm not getting into options that nobody else is trading. So I'm not going to see that right now. I could see it though if I change my columns and bring in open interest and volume. I don't need the implied volatility there right now. I'll leave the theoretical value and the Greeks. And you can see this may not be such a great one to trade because there's a lot of zeros. So instead, let's see, find an option that actually has some volume with it, or at least open interest. There's nothing, even if I go to sooner. And that's the problem with some of these weeklies. There's activity. So very short term, there's only 4 days left till expiration. That's not going to help me very much with the volatility. The Vega is pretty much 0. I don't have to worry about time decay, however. That's a nice bonus. But there's liquidity somewhat. I might just have to find something better altogether. But that was an experimental one I did a while back. And again, actually, it was months ago. I think I forgot to exit out of that because I was expecting us to break down from the 65, and obviously we have not. Broke to the upside. We'll see if that's going to be continuation. To me, this looks like it might be a false break. I say that because typically when you consolidate like this, which we're doing, you usually leave that consolidation the same direction you entered, which in this case, we were moving down. We went sideways. We should break down. When you get a break in the opposite direction, often it's a false break before you get a violent move in the opposite direction. And the nice thing about this position here is you've got this little basing, and there's your origin of imbalance of selling pressure. We basically ran right into that and should be dropping from here. When you break in the wrong direction from sideways consolidation, you typically snap back to the opposite side of that consolidation. You may not break out right away, but you usually snap out. I think I have an example. It was it the Dow this morning? I had a trade like this morning. I can't remember if it was the Dow or the NASDAQ or one of the markets. I don't remember which market it was. Obviously, the Dow broke to the upside late in the day. No, it wasn't this. I can't recall it off the top of my head. I apologize. But yeah, typically looking at that basing, that sideways basing, you're going to break in the same direction that you entered, which should be, in the case of the Australian dollar, down, and we broke up. So to me, this looks like it might end up being a good trade, and especially because we're coming into maybe a little more tight right here, the origin of all that selling pressure. There's no buyers in that area. Prices move very dramatically downwards, and we're likely to run into that selling pressure again with the lack of buying pressure, drives right back down to the 64.79 area. And in this case, volatility might rise. Oh, wrong page. There we are. Right now, I'm barely negative, about 220 on this. And it's because the short puts obviously are profitable because of time decay, but the long puts are losing value. They have no intrinsic value at all. Another one that I have going on right now are bullish spreads actually put on. I forgot all about these guys. And it's probably a good thing because they're up very well. I have a bull call spread and a bull put spread. The bull call spread right now, actually didn't divide them up into the separate positions, unfortunately, but where's my calculator? There we are. Move this off to the side. You can see that the long call spread right now went long on the 22,000s, and that's profitable by $42,355. The short call is losing $32,135. So that's a net of $10,000. So let me put that in there real quick. Up 10 to 20. On page. There we go. Now on the other side, we have the puts, and I have the short 22,000 put, which is actually average P&L open right now. Why is it showing P&L open 0 there? I'm not sure why. Maybe that's the actual number, because I don't think it's up $10,000. I think this is the more accurate number here, because that call can't be worthless. It is deep out of the money, though, because that would show that the calls have 0 value and the puts are the ones that are making the value. But this should be profitable right now because those calls are in the money, both in the money. Anyway, I'm not sure why the P&L open looks different than the average P&L open, but looking at this one, I'll use that number as well. Right now, the short put is 25,870, while the long put, obviously losing 19,400, that is 64.70. That's actually right, based on what's going on. Now, why is there a $4,000 discrepancy between the two? Well, remember, this one's capped anyway because I sold short above the long strike. I sold a short strike. So I've capped off my profit 100%. I can't get any more than that. At this point, I really should be exiting because the only thing that could happen with this is it gets worse and worse because I'm basically eroding time value away. This has no intrinsic value whatsoever. So time value is much more of a factor on this, and it's eroding that much, much faster and further. Let's see, started day price, average open. Yeah, this is the price I paid for them. That's the average price now, it looks like. That can't be right either. Short, no, I did short, and that's the price now. So again, if we were to price this one out on OptionStation Pro and see where we are currently on both of these, in QZ25. Oops, there it is. And we've got 52 days left till expiration. The bull put spread, let me just make sure on my analysis page, I'm not going to have a bunch of positions there. Nope, we're good. And before I go on that, I want to clean the trade ticket up. There we are. So it's all good to go. And it was short 22,000. Need more strikes. Wow, this is way out of that. I've had these for a while. Let me see. I might as well just go with all strikes at this point. There we go. So it was short 22 and long 21. So 22, long 21. There we go. And it's about a $20 credit right now. That wasn't my original pricing. My original pricing was what? Go back to the slide and the calculator. We could see that on the put, I sold for 1376.75, and I purchased the other put for 1023.50. So it was 353.25. And what is this showing now? 2050 credit. So that's what it would cost to buy it back at this point. So minus the 2050, that should be my profit right now. But remember, this is in point. That's the not points. I'm sorry, that's in points, not in the actual dollar value. So you have to multiply it by the value of the point, which is 20. And there's $6,600. So that's what we calculated. I had 64.70. So might have adjusted just a little bit. It does also take into account some of the volatility and everything else. But yeah, that's pretty close to what I had calculated, $6,400 profit. And we can take a look now if I bring this over to analyze to see what's affecting this particular trade. There we go. You can see what's happening with time. Now is the green, and the further out we go in time, the higher we go in profit. Obviously, with last price being way above where we are now, we're at max profit. It looks like we can't really do much else. There you are. Where are you? Bring the zoom back down and the pan. There you go. There's last price. So there's really no more benefit other than letting this expire worthless, because then I'll get to keep 100% of the premium. That's what's happening. The further we go in time, the more profit I gain, because again, time value is eroding this, but this is so far out of the money at this point. It shows a theta right now of my position with the current price is 0. So nothing's really affecting it other than time decay. And if we go to the call side, take that off, go back, get rid of the position. Here we go. And it was long 22,000, short 23.5. Obviously, it was a good trade. So long 22,000, short 23.5. There we go. And right now, natural's at 1,500. The initial entry for me, though, was a lot different. Let's see what it was. Again, the call was bought for 1488, and then the other call was sold for 628.75. So net was 859, and the current is what, 1500. So we're at 640 times 20. Again, there's about, I had 10,000, but this is showing about 12,815, if that's the correct pricing right now. So doing very well on that, but like I said, it's already at past its peak, and basically I'm going to be eroding my profits as time passes. You can see this is showing now, and pretty much everything is so far deep in the money. I'm not getting any differences in any of the times by any of the effect. That's so funny. That's that deep in the money. So again, I should probably close that one out, because I'm not going to get any more profit out of this. It's already maxed out as far as it can go. And the only thing that's happening is time decay is eroding the value of both of those options. So that's one thing I was looking at there. Another thing I'm looking at going forward now, and just to go through my process before we end this session, because we're almost done, I was looking at bearish opportunities potentially on nat gas. Now, this is not a recommendation, because unfortunately, we're actually into this area, not for the first time. The imbalance formed back here. So we're turning at this area 4.1 multiple times, and you can see we've lost a lot of momentum. So there may be an opportunity, not just for a bearish trade, but if we don't have momentum, either bullish or bearish, we could end up bouncing off the low side here at about 3,635. What I would want to see is what's going on with volatility. Volatility seems to be rising a little bit, but overall, we're in the mid to lower range. And again, if I'm trying to judge the individual volatility of the security, I can't do it with the futures. So I could look for an ETF perhaps that tracks nat gas. We have, what is it, UNG? Is that the one? US Natural Gas Fund. And overall, this is showing me, yes, implied volatility seems to be relatively low. And let's take a look at the options. NG, whoops, not NQ, NGZ25, going to the options itself. And let's see, we'll do LNEZ25. That's the monthly option. And hang on, we don't need all the strikes available. Let's just do maybe 20 or 30 of them. Notice the liquidity here. That's why I chose the LNE, because I know the LNE is the monthly option and it has the best volume. If I go to these weekly options, everything changes, zeros out. So I don't want those. I want volume and liquidity. You get much better pricing, obviously. Again, I'm looking at an area we're coming down from on page. There it is. Oh, didn't change that chart. NGZ25. And I'm expecting this to drop from around 4.1 down to potentially 3.5. So if I'm experiencing relatively low volatility, expecting volatility to go up, I should be seeing undervalued options. And my theoretical pricing on these options right now, unfortunately, it's not going to be giving me good data. It looks like it's 16 cents. There's no way. It's not that underpriced. Okay. Again, I might have to look at this during the day tomorrow when the markets are more active to see what is my theoretical value compared to the current pricing to see. But I do know that volatility is relatively low and likely to rise. So I'm probably going to want to go on the long side. If I'm bearish and long, I'm going to want to do a bull put spread, bear put spread versus a bear call spread if I was expecting volatility to drop. I'm expecting volatility to be low right now and rise in the future. Although I could just buy a put, but to protect myself, this is the difference here. If I just buy the put, 371, let's get rid of those calls from the NASDAQ here, and I'll analyze. So that's a long put. That'll make the most amount of profit potentially. Obviously, my target is, again, about 3.5 area. I'll put it 355, a 350. There we go. And because I'm long this option, I'm probably not going to want it to go to expiration. Although if it does, you can see that what's going on there? It should be positive, not negative. Long put 4.1, showing theoretical P&L as a negative 30 grand. That doesn't make sense.
Isn't that because of the price?
Maybe the price is that bad, perhaps. But anyway, my point is if I want to do a spread, now what happens is this changes everything around. So I'm going to go ahead and buy that one and sell below where I expected to go, which is at 3.5. There we go. I probably should have used the natural. I did the mid price anyway. Analyze, get rid of the single option. And now my spread looks a little different. But again, the price seems off. Yeah, it must be way off on the pricing. I'm not getting accurate pricing right now. But basically, what'll happen, you can at least compare these two before we go. You can see my max profit. Yeah, the vertical spread is not showing the max profit. That's why something's wrong with the pricing here for now. And the Greeks are off. But it gives you a little bit of an idea. My delta, I'll make more profit from price movement on the individual leg versus the spread, but I'm also at a much bigger risk of time decay. You see how I've defeated my time decay to a certain extent, and volatility is not as much of an impact. So the reason why I choose the spread over the individual option is, yes, I lower my reward, I'll lower my risk, and I also basically neutralize some of the Greeks that are going to be affecting that option. So that's why I choose the way I do. Anyway, unfortunately, I've run out of time, so I got to hand this back over to Jesus. Hopefully, you guys got some good insight on some of the option strategies I've been looking at and what I'm looking forward to. And I'll see you again in the next session. Thank you for having me.
Thank you, Brandon. And I know that after hours, data just gets out of whack. That's understandable. Yeah, great. Thank you, everyone, for joining us today. Thank you, Brandon, for your time as well. I have shared a link to where the recordings are. So all these presentations on futures options are recorded, and that's the link where you can find the recordings. I think we're still titling them differently, so you know which strategies are covered, right, Brandon? So that if you look at the whole collection, you see what examples are shown. So thank you. Thank you for that. Again, thank you everyone for attending this webinar. Have a wonderful evening and check out our events calendar for any upcoming classes. Brandon, goodbye. Great seeing you again. See you guys later. Bye-bye.